Is your credit score not as high as you'd like it to be? Or maybe you have some debt that's still going to be showing up on your credit report, and you feel like until these things are fixed, you can't even think about purchasing a home. Well, stick around, because today, this loan product might be a great fit for you. We're going to be talking all about FHA loans. I'm Hannah Escher. I'm a mortgage advisor and rookie real estate investor with 2 properties of my own, and I am super excited to share with you this loan product that is backed by the federal government and is a great option for first-time buyers and buyers beyond. Let's get into it. So what exactly is an FHA loan? I know, FHA, what does it stand for? It stands for the Federal Housing Administration. And this is a loan that is insured by the federal government, such as a VA loan and USDA loan. Now, this is different than a conventional loan, which is backed by Fannie Mae and Freddie Mac. This loan program is something that the government offers in order to help make home ownership more affordable and accessible to everyone. The reason this loan program may be a great option for people who are maybe struggling to get their credit score above that 700 mark, or maybe have more debt that they're thinking they have to pay off before they're getting into a home. This program has much looser requirement options. You can have a lower credit score, even under 700, and you can have more liabilities or debt showing up on your credit report and can still qualify for a higher purchase price and loan. The reason that is because with an FHA loan, you can actually go up to a 55% debt to income ratio on the back end. Now, a conventional loan only allows you to go up to 50% on the back end. There are other requirements that have to be met within this program in order to get to those higher debt to income ratios, but it's very possible to achieve for most borrowers. So it's a very special part of this program and allows people with maybe student loans or car payments or credit card payments that are maybe higher than the average still be able to qualify for a home loan. Something I want to talk about there real quick is debt in general. As a first-time buyer, I remember thinking that I had to have no debt, like zero debt showing up on my credit report in order to go get a pre-approval and in order to go buy a home. That is completely false. And the reality is most people are going to have some type of debt showing up in their profile when they're buying a home. An FHA loan specifically allows even for more of this. The federal government uses this program specifically to try to help more people be able to get into a home. And having that wider range of debt to income ratio available is going to help more types of borrowers be able to purchase that home. Now, a misconception about FHA loans is that they're only for first-time buyers and that this is like a first-time homebuyer program. That is also false. So FHA loans are not just for first-time home buyers. You can have owned a home before and you can still get an FHA loan. Now, there will be some requirements around how many homes you can own at once while you're applying for an FHA loan. Usually, you're only able to own one home at a time if you're using an FHA loan. However, it just depends on your specific situation, and that's something you can speak with your trusted mortgage advisor about. This program has many different nuances to it, and it's very important to speak with trusted professionals and make sure you go through a full pre-approval process if you're looking into this program. Something else that is fantastic about an FHA loan is you are able to have non-occupying co-borrowers be able to help you make that purchase. So for example, let's say you're looking at a specific price point, but you're just shy of that mark with your pre-approval. With an FHA loan, you can have a co-borrower on your file who is not going to be occupying that property with you. Again, this is a looser requirement that the federal government has put into play in this program to help more people be able to get into homes in a more affordable manner. So that's something to keep in mind as well. Just because you may not be able to reach that price point you're looking for with your own income numbers and your own debt to income ratio, talk to your mortgage advisor about adding someone else to your file. They don't have to be living in that home with you. They can be non-occupying and still be a co-borrower for you. Now, something to think about when you're looking at FHA loans is the property type. that you're looking at. This is one of the things with FHA loans that can be more of a challenge. Now, certain types of properties may not be approved through this loan program. The reason being, this is again a government-sponsored and government-insured loan. And so the government, it does have specific property requirements that have to be met in order for this loan to be completely approved on that property. For example, there are going to be certain condos that are not going to be FHA approved. So if you're in the price point where you're looking like, I really need to be purchasing a condo and I can't be at that single family home price point yet, then I would really encourage you to go look at first-time homebuyer conventional loans. There's a whole video about that. Go check it out. You can get into a first-time homebuyer conventional loan with as little as 3% down. This brings me to one of the most valuable parts of an FHA loan, and that is the low down payment requirement. An FHA loan allows you to get into a property with as little as 3.5% down. This also includes properties that are 1 to 4 units. So you can do 3.5% down for up to a 4-unit property. That is a very special guideline and allowance. Just recently did conventional loans allow borrowers to be able to get into a property that's multifamily with just 5% down. FHA has had this as a guideline available to people for a long time. And this is where those non-occupying co-borrowers can really come in handy, right? Because that multifamily property might be higher priced. It might be difficult to cover that debt to income ratio by yourself and maybe even by the monthly cash flow on the property. That's where a non-occupying co-borrower could be really helpful. So that is a huge perk with FHA loans. That does not only work on single family homes, it goes all the way up to 4-unit multifamily. The other large perk about FHA loans is, like I mentioned in the beginning, you don't have to have a skyrocket high credit score. So if your credit score is below 700 or in the low 700s, an FHA loan might actually be a really great option for you. The reason being, if your credit score is lower, you're not going to be penalized as much with your interest rate versus a conventional loan. If your score is below 700 or even hovering around 700, you're really going to see the difference in the rate options available for you. With an FHA loan, if your credit score is lower, you're still going to be able to get very competitive interest rates. And that is a way that this loan really makes home ownership more affordable for more people. The other thing with FHA loans that makes this a very affordable loan for more people is going to be the mortgage insurance cost. Again, if your credit score is lower, let's say below 700, on a conventional loan, your mortgage insurance would be so expensive if your credit score is below that 700 mark. On an FHA loan, it is a flat mortgage insurance requirement, and it was even reduced recently. So it's even lower cost than it was before, no matter that credit score. Now, if you have a credit score above 750, but maybe you don't have a lot of funds for a down payment, go check out the first-time homebuyer conventional loan video. That might be a better option for you. Because if your credit score is high, your mortgage insurance is going to be very affordable on conventional loans. Versus, again, if your credit score is under that 700 mark, FHA loan is going to be more affordable for your interest rate and much more affordable for your mortgage insurance. Something else to keep in mind with an FHA loan is that the mortgage insurance, even though it is affordable, is going to usually stay with that loan for the life of the loan until you refinance into a new loan. The only time this differs is if you put down a larger down payment on that FHA loan. Then the mortgage insurance will fall off eventually, but it's still going to be over 10 years of being in that loan. So most of the time, if you're looking to remove the mortgage insurance with an FHA loan, the best option is going to be refinancing. So let's cover these pros and cons real quick of conventional loan versus FHA loan. An FHA loan is a great option. If your credit score is under 700, if you have limited funds to put towards that down payment, maybe you need a non-occupying co-borrower, and maybe you have a higher debt to income ratio. Maybe you have those student loans and that card payment and those credit cards. That's okay. Versus a conventional loan, which still can have a low down payment requirement. However, the credit score requirement in order to get favorable terms that are going to be more affordable is going to be high. So if you're someone with a credit score of over 750 and maybe you have some debt, but not as much as you could, then a conventional loan might be a better option for you. At the end of the day, an FHA loan has looser requirement options and allows more types of borrowers with more types of income situations to be able to be approved for a loan. Now, I know we covered a lot of information today, so if you have questions, drop them in the comments below. I would love to hear from you. I'm Hannah Escher. You can search my name on BiggerPockets or find me at hannahescher.com. And if you found this video helpful, like and subscribe to the BiggerPockets Rookie channel for more videos just like this.